be more students coming in, but we're going to start. Good evening. My name is Alice Simon. I'm an economics professor in the Department of Economics and Business. I'm also the faculty advisor of the Walter Amati Center. I welcome all of you to our annual Economic Outlook Conference. I am very excited about this evening. And I would like to introduce to you our brand new administrative director of the Walter Amati Center, Karen Gray, who brings 25 years of phenomenal higher education experience to our family with a passion for leadership that's unbelievable. So I really encourage all of you to get to know her. So having said that, I'd like to introduce you to Karen.
Thank you very much. And I'm excited because I get to introduce tonight's moderator. So Dr. Goran Skosples graduated with a major in economics from Lake Forest College, Illinois, and received his PhD in economics at the University of Illinois at Urbana-Champaign. His teaching focus includes comparative economic systems and macroeconomics. His research deals with institutional changes in post-communist countries of Eastern Europe and the former Soviet Union, with a particular emphasis on banking. When he is not teaching or writing, Professor Skosples enjoys working on vintage cars and motorcycles and riding bikes around Delaware with his family. We are honored that he has been at Ohio Wesleyan University since 2006. Please join me in welcoming our moderator for the 2019 Economic Outlook Conference, Dr. Goran Skosples.
Good evening, everyone. Thank you for coming. I always enjoy being at these events, at this event every year. Lots of good conversations, lots of good perspectives. Plus, you get a free lecture. What else can you ask for? And somebody says there is no such thing as free lunch, or I guess free dinner. So thank you, Karen, for introducing me. My privilege today is to introduce the three of our panelists. We have had all three gentlemen here in the past. Last time they actually lined up in exactly the same order. Lineup was in 2016 for our 2017 Economic Outlook Conference. It was great, so we decided to call them back. And undoubtedly they will be here in the future as well. They're experts in their fields, they're easy to talk to, and they're just good guys to hang out with and go out and grab a beer. You should stick around after and ask them questions if you want. They'll be very glad to answer any questions you might have. So the first to my left is Mr. Bill LaFayette, who I've met a long time ago. He was still working with the Columbus Chamber. He was doing economic analysis for them. Since then, he's moved on, and he is in charge of his own firm called Regionomics, doing lots of economic analysis, especially for the Columbus area and Central Ohio area. Lots of times you can hear him on NPR. I always perk up when I hear his voice on NPR when there's some news about Central Ohio, whether it's about employment, about new businesses being created, and so on. His clients adore him. He does provide lots of very useful analysis. Some of the comments are, he understands trends and is able to organize and simplify complex ideas. Like a good teacher, he also teaches at Ohio State. Insightful analysis was critical for the success of the project, one client states. He understands economic and community development, and he really knows this area. He's been living in the area, he knows it, so his analysis is very useful. Thank you for being here and offering your advice on the economy, or outlook for the economy. Next to him is Mark Schweitzer, who is Senior Vice President of Research at the Cleveland Federal Reserve Bank. We've had the privilege to have Mark come here several years in a row, and always an excellent presentation. He was also so impressed by this place, and he brought his son along, and his son decided to stay, and he's a student now. Mateus in the audience, he's a student at Ohio Wesleyan. Mark was what you would consider, for a PhD economist, relatively a standard path. He took a position with the Cleveland Fed, then he went off Bank of England, came back to the Fed, went to Kansas City's branch in Denver, and then came back to Cleveland again. So Cleveland seems to be the area where he likes to come back. Did a lot of community outreach, and he really understands what goes on, especially in the labor markets. One of his recent papers is called Opioids and the Labor Market, very current, discussing what is the impact of opioids on the unemployment rate in the economy. So very interesting, very current, up-to-date research. It'll be, I'm looking forward to hearing what you have to say about our economic outlook, of course, with usual Fed disclaimers. Put up. And then farthest to the left, or your right, Ian Sheldon, who is an economist at the Agricultural School of Economics at Ohio State. Very witty, very sharp, very smart, very engaged, does lots of research, very active, obviously, in teaching, community outreach. Any event I go to, I seem to see him there, and he's one of the main people presenting, offering opinion, very valuable, insightful. He is originally from Great Britain, but then Great Britain lost him. I guess he preceded Brexit by a few years, so he left Great Britain and came here, and we are lucky to have him. One of the recent papers he actually wrote was on economic nationalism, the U.S. trade policy versus Brexit. So I'm actually looking forward to hearing what he has to say about trade, given that it's very current and in the news all the time. So the format is going to be, each presenter is going to talk for about 12, 13, 14 minutes, somewhere in that range. I'll try to keep them on track. And then after that, I will ask them questions, whether they have any questions of each other, and then we'll open the floor whether you have any questions. So please welcome me and join me in welcoming them, and welcome to Ohio Wesleyan. So we are going to start with Ian, who's going to give us an international outlook. Then he's going to follow by Mark, a national perspective, and then finally by Bill, who's going to give us more of a detailed view of the local economy. All right. Let's pull this up. There you go.
Well, thanks very much, Goran, for that very kind introduction. I've been talking about trade policy for the last 2 or 3 years, perhaps no surprise, and my usual joke is I've been a trade economist for nearly 40 years, and finally I'm relevant, and I'll just repeat that I felt relevant last year, and I feel equally relevant this year. So tonight I'm going to talk about, give you a global economic outlook, and I'm particularly going to focus on what I think are the risks from the trade war, and then end my discussion with some fairly critical remarks about why do we actually go to a trade war with China, what are the reasons for that, and why I think they don't really hold much water, actually. So the global economic outlook is, I draw most of this from the most recent International Monetary Fund's forecasts, but over the past year, we've seen a pretty broad-based slowdown in the global economy in terms of industrial production, that's the blue line, and then world trade, that's the red line. These numbers are showing you year-over-year percentage changes, and you can see that we're going into negative territory with respect to the volume of international trade, and that's perhaps not surprising, given that the two largest economies in the world are running a trade war with each other right now, and involving other major economies around the world. The US numbers, they're not as extreme as this, but we're certainly seeing a slowdown in industrial production, and that's something that Mark may talk about, but the chairman of the Fed has certainly noted this in his recent remarks. So what's this driven by? It's partly driven by a significant downturn in automobile production, notably in China. That's driven by the fact that some tax incentives to buy automobiles have been removed in the Chinese economy, and also in the Euro area, where new environmental regulations are impacting choices that consumers are making about which automobiles to buy. Particularly the German automobile industry has shown a significant reduction in both production and sales. We also, not surprisingly, we're witnessing very weak business confidence due to the US-China trade war, and that has shown up in the chair of the Fed's comments recently. And then finally, we've seen a significant slowdown in the Chinese economy, not just because of the trade war, because the Chinese economy has been slowing down anyways, partly because they're trying to deal with the debt burden, partly because the Chinese government has been trying to redirect the Chinese economic model, and we're forecasting Chinese economic growth to go below 6% in the next year. Now, this slowdown in industrial production has fed into a decline in trade growth, so this graphic here is very straightforward. This shows you the contribution to global imports by three big players, the US and Canada, that's blue, the Euro area, that's yellow, the red is China, and you can see by the end of 2018, we saw a significant slowdown in the amount of trade accounted for by the US and China in particular, China going into the negative territory. And if you were to show other parts of Southeast Asia here who are connected to the Chinese value chain, you'd see them in that negative territory as well. So right now, most macroeconomic forecasters who look at global macroeconomic issues are arguing that the risks to the world economy are actually pretty skewed to the downside. Why? We're seeing significant risks due to disruptions in international trade and also disruptions to supply chains. As you know, supply chains now dominate international trade in the world economy. It's not just traditional trade between countries in commodities, it's sophisticated trade in intermediate goods that cross borders multiple times. There's been a significant decline in risk appetite. In particular, we've seen a flight to safe assets such as US Treasuries, and that was one of the reasons why we were observing yields on long-term bonds, US Treasuries, 10-year Treasuries going down, and there was some concern for a while about the possibility that we would exhibit yield inversion. In fact, we did see yield inversion, which is supposed to be a very good indicator about the likelihood of a recession. And we've also got political uncertainty, and you can think of Hong Kong. Brexit is obviously a major form of uncertainty in the European Union, et cetera, et cetera. So the IMF, the International Monetary Fund, the new leader of the IMF forecast last month that if the US-China trade war continues, that the cost of the global economy is going to be about $700 billion by the end of 2020. If you want to put that in perspective, that is the size of the Swiss economy. That's the Swiss GDP would be lost to the global economy if the trade war continues. Both the US and China are affected by the trade war. This is the IMF's forecasts about the impact on the US's real gross domestic product. The green line is the one to look at. As you go down these lines, they're bringing in the initial tariffs, then successive increases in tariffs by the US. Then you get the market uncertainty effects, you get stock market reaction, and then you get these feed-through effects into productivity. So the US is expected to decline by about two-thirds, three-quarters in terms of the benchmark in 2017. The Chinese economy takes a larger hit because it's so dependent on international trade. We're talking about a 2% reduction in their GDP from the 2017 benchmark. So the general view, this would be my view, but more importantly, it's the view of economists at the IMF, the World Bank, the OECD, that's the Organization for Economic Cooperation and Development. There's a very clear argument. We need to reduce trade tensions and we need to solve trade issues through the multilateral trading system, the World Trade Organization. So why have we taken on China? So I'm going to start poking holes a little bit here, like I did last year. First of all, the US would like to increase market access, and I think it essentially instigated the trade war because it's moved to a strategy of power-based bargaining, which is we're going to unilaterally raise tariffs and we expect you to reduce your tariffs. So this was the argument that we would bring China to the bargaining table, as opposed to following the rules-based system where trade negotiations occur at the multilateral level in Geneva through the World Trade Organization. Unfortunately, all this has done is generate an intensification of the trade war. So if you look over here, these were the tariffs before the trade war began. China had, on average, tariffs of 8% against the US, whereas the US had tariffs of about 3%. And you can see if all the tariffs go into place right there over on the right, tariffs are going to be averaging between the two countries about 25%. To put that in perspective, the US tariffs against China before China joined the WTO in 2001 were 28% on average. And the average tariffs under the Smoot-Hawley Tariff Act, I don't think there's anybody in the room old enough to remember the Smoot-Hawley Tariff Act. It's a matter of economic history. But tariffs then averaged above about 35%. So these tariffs are getting awfully close to the kind of tariffs we observed at the end of the beginning of the Great Depression, the part of the Great Depression. So I would argue that the US has not managed to bring China to heel in some sense in terms of getting them to lower their tariffs. And that's not surprising given that the US took unilateral action to raise tariffs. China simply retaliated. Second, the objective of the trade war is to reduce the trade deficit. Now, I waxed lyrical about this last year, so I'm not going to repeat everything I said then. But most macroeconomists would argue that tariffs are a very bad instrument to try to solve the trade deficit. The aggregate trade deficit for the US is actually driven by underlying macroeconomic forces. All a trade war is going to do is maybe reduce some levels of international trade, but it doesn't resolve the underlying problem, which is that the US has a very low savings rate, and we're also running a very large fiscal deficit. Now, I don't normally say, I told you so, but I'm going to do that this year. This is one thing I got right last year. This is the current data for the US trade balance, and if you look over there to your right, the red line is the US good. That's just goods. It doesn't include services. But last year, we pretty much hit $850 billion in terms of our trade deficit. And you'll notice this is a very long-running phenomenon. This goes back to the early 1970s when we came off the Bretton Woods exchange rate system. Right now, the US this year is running, up to August, is running a trade deficit in aggregate of $588 billion. That's larger than what we were running last August, January to August. So I think we're going to hit $900 billion on the goods trade deficit. In other words, the trade deficit's increasing. And likewise, the bilateral trade deficit with China is running right now at $231 billion. Last year, it hit just under $500 billion. So our deficit with China accounts for just over 50% of the total aggregate trade deficit that we're running. But I don't think the trade war is going to solve that problem, and that's not an opinion that many macroeconomists would disagree with. Third, we want to target, or the administration has argued, we need to target China's exchange rate manipulation. Prior to August 2019, when the Treasury actually named China as a currency manipulator, China didn't meet either the criteria set out by the IMF or the US Treasury's own criteria to be an exchange rate manipulator. And very quickly, the criteria for these manipulation are intervention to push down the currency. That means China would be selling the renminbi or buying the dollar or some other currency against which the renminbi is evaluated. Secondly, they're running a large current account surplus, which China is running a large current account surplus. But the Treasury adds in a third criterion, which is it's running a bilateral trade surplus with the US. So this is a quick graph. This is sort of, you have to think backwards here. This is how many renminbi you get to the dollar. That very flat portion from the mid-1990s through to about 2005, at that point, China pegged its currency to the dollar at just over 8 renminbi to the dollar. And then in the mid-2000s, China, under a lot of pressure, both internally and from the US in particular, went for what we call a dirty float. They no longer pegged it just to the dollar, they pegged it to a basket of currencies. And from about 2005, you can see there's quite a rapid appreciation. It looks like a depreciation, but that's because you're getting fewer renminbi to the dollar, which means the renminbi is actually appreciating. And the renminbi actually appreciated by about 30%. But we know from the data that China actually did manipulate its currency to try to slow down that appreciation over that period. But more recently, China has actually backed away from trying to keep down their currency, and they spent $1 trillion of their foreign exchange reserves in 2015-16 to try to prop up their currency. So it's very hard to argue that they have actually been manipulating their currency to get it to depreciate. It's been more about letting it appreciate. And right now, the evidence suggests that on balance, they're neither buying nor selling the renminbi. So they're not violating either the IMF or the Treasury's criteria. They do run a large current account surplus, but it's only 1% of GDP, and the US Treasury's cutoff is 3%. So for those first two criteria, according to the IMF, they're not currency manipulators. But the Treasury took a position, I think for political reasons, not for any sound economic reasons, that they are manipulators, and largely because they're running a very large bilateral surplus with the US. But let me point out a very simple piece of economic logic here. Let's suppose the US had balanced trade and there was no currency manipulation. It's still possible for the US to have a bilateral trade deficit with China. Why? China, irrespective of currency manipulation or anything else they may or may not be doing, has a huge comparative advantage in producing or assembling many goods across the spectrum, and they're gradually moving into more value added in terms of what they produce. So I think it's kind of a false argument to argue that, that this trade balance would simply go away if we stop them manipulating their currency. And finally, we've pushed the Chinese to have a flexible currency. The thing about a flexible currency, it can go up or down depending upon economic conditions. And it's a simple truism that if we slap 25% tariffs on average across $500 billion worth of imports from China, we as American consumers and purchasers of Chinese goods, we decrease our consumption. That's a logical argument. What happens to the renminbi? It depreciates because Americans are using less dollars to buy goods denominated in the Chinese currency. So there's a natural tendency, if you start a trade war, that you get effects on currencies. And we do not want the US to enter into a currency war with China. I think we would lose because we don't have the foreign exchange reserves that China has. Finally, and this is where most economists would agree, there is some argument for taking on China. In fact, I think there's a very legitimate argument for taking on China, and this is concerns over some of their other trade practices. And these concerns are the following, and you've probably heard these in the media. Forced technology transfer through joint ventures, discriminatory licensing of that technology, theft of intellectual property, restrictions on investment in China, and most importantly, what started the trade war in the first place were subsidies by the Chinese state, or more opaquely through the Communist Party structure, particularly to state-owned enterprises. And that was what really drove the start of the trade war. The initial tariffs were put in place mostly in steel and aluminum because China, the argument is, using subsidies to expand its export share. And we've actually been targeting their exports to the US with countervailing duties and anti-dumping duties now for a number of years. The problem is it's really hard to detect these subsidies quite often. So even though we could argue that we should probably take a WTO case, it would be hard to win against China except for obvious cases of state subsidies. But I think the only way to do this would be through a grand coalition. In other words, we should use the power of the EU, Japan, and the US to run a joint dispute at the WTO where China would be less likely to retaliate against basically the three largest economies in the world if we sort of added them up and excluded China. Now, the US is very frustrated with the WTO dispute settlement mechanism, but the problem, I think, with going it unilaterally is if the US does actually achieve anything in the trade agreement, it's going to be, there'll be free riding by the EU and Japan. I think it's going to be a very shallow deal, and I'll say what I mean by that in a minute, and then I'll finish up. And I think there's a clear potential to undermine the WTO. So you've probably heard about this phase one trade agreement. They keep talking about reaching an agreement. We haven't reached an agreement. We were supposed to reach an agreement at the G20 meetings, but that doesn't look like it's going to happen. What's in? Well, they said they're going to stop raising tariffs. So in case you don't know, you probably should buy a new one of these by December the 15th, when tariffs are going to go in at 25% on electronic goods from China. So I'm going to buy a new iPhone in the next few weeks. I'm a rational economist. The Chinese have made and promised some concessions on intellectual property, That's largely driven by the fact that Chinese companies themselves want to protect intellectual property. It's not just that the American firms and other firms are having their intellectual property stolen by the Chinese. There are commitments on agricultural imports. I'm afraid I think the forecast by the administration of imports by China of $50 billion in 2 years is patently absurd. The highest level of imports from the US by China in agriculture was 27 million about 6 years ago, and we've actually been seeing a declining share of imports over the last 7 or 8 years. I think that's pie in the sky, and how can they possibly commit to importing that much when their own economists have said we don't have enough demand for $50 billion worth of imports? But having said that, any relief to farmers, especially soybean farmers, is going to be a good thing. Finally, China's made some commitments on currency, but what's not in this deal is nothing on subsidies. And subsidies were the original reason for starting the trade war in the first place. So in conclusion, the trade war is already imposing costs, and I think they're only going to increase as the trade war intensifies. There are significant downside risks to the global economy. I think the trade deal is going to be shallow, largely targeted at the US-China bilateral trade deficit. And I think there's going to be very little focus on what we call behind the border, except perhaps IP protection. I think a coalition of WTO members would be a much stronger proposition in terms of getting a deal. Finally, and I just leave this as a sort of a word of warning, the moral of the story here, I think, is that the failure of the US and China to follow the rules-based trading system runs the risk that China won't follow the system when it becomes, or if and when it becomes, the world's largest economic power. And I would note, and this is my finishing point, China has lost 30 cases at the WTO and has complied with the panel or the appellate board rulings in every one of those cases. Thank you very much.
Thank you, Ian. And now we have Mark.
That was very helpful. I get to avoid all of those Treasury topics, and I'll just try to give you a little perspective on today's outlook. And today's outlook is an interesting one, so I'm going to start with a two-handed outlook today. And of course, you know, this is a reference to Harry Truman, who, you know, once said, "Give me a one-handed economist. All my economists say on one hand, and then, but on the other." And I was looking for various online figures to sort of illustrate this. And actually, one of the things that, you know, I just say it was too bland. I'm not going to use that. But there was a really nice one saying all experts should be two-handed. So with that as motivation, I'm going to show you my disclaimer because I want to keep my job. That's a one-handed issue. And I want to briefly talk a little bit about sort of where are we today. So, you know, a little while ago, we would have had a yield curve inversion. A yield curve inversion is when the 10-year Treasury is below the 3-month Treasury. That would be those green and yellow lines. They look like they're kind of brown and green here, so we'll go with brown and green for you. And we had a pretty substantial inversion of the yield curve, and people were pointing to that as a sign of recession. The other financial market indicator that we do look at is the S&P 500, so how well have our stocks been doing? And you can see that the stocks have continued up and to the right. And so the general outlook on the financial markets, you know, are split. They really have this sort of two-handed aspect. One side is saying, look, we don't see the growth prospects. Those growth prospects are why 10-year Treasury yields are so low. Because when I think about what goes into a 10-year Treasury yield, and this is what you'd be taught in class, is one, you want to account for inflation. And then two, you want to account for sort of what's the real return that I should get in my economy. And on average, that ought to be kind of related to the growth rate. So when you add those two things up, your 10-year Treasury is saying somehow we're going to get inflation plus growth that's kind of vaguely below 1.7%. Now, there are a lot of other reasons why Treasuries can be low in this international trade, and there are a lot of issues that can sort of help depress the 10-year Treasury. But that is a very different indicator than an all-time high in the stock market. So that's where we're starting out. Now I'm going to delve into some data to describe sort of why we do see it as a little bit two-handed. If I start with gross domestic product, it has slowed a little bit over the year, and we are now down to a 1.9% growth rate. We do look ahead, so we're already thinking about the fourth quarter, and it looks to be in that 1.5% to 1.8% range. Nothing really terrible there, but definitely slower. Where is that coming from? Almost all of our growth is continuing to be in consumption growth. So in the latest quarter, we would have had about 1.9% growth accounted for, and that's that yellow area there, is accounted for just in sort of consumers, buying more goods. And so, that is a pretty reliable source of growth. You can see that it was key to the second quarter too. Now, the two quarters have very similar growth rates, but in the second quarter, we had a lot more offsetting items. We had, negative net exports, and Sheldon definitely pointed out why we might have negative net exports. That turned out to come in a little better in the third quarter, but, again, this is something that, as an economist, we're likely to look out and say, this is likely to be weighing on our outlook for a while. So that shows up when we start thinking about, where growth is going to be. So we're going to walk through some of the key underlying areas, and I want to have kind of a longer-term perspective on this. I, of course, want to look at the very latest data and say, how have things been moving recently? Because that's an indication for sort of where change is. But I also want to look back and say, how have we evolved over this expansion? And then how do we compare to past expansions? So we're going to have a number of charts that go from all the way from 2000 onward. And so from a consumer perspective, one of the really high-frequency data that we get is about consumer confidence and willingness to go shopping, essentially. The University of Michigan indicator is all about sort of my willingness as a consumer to buy. And so we have seen it move around a little bit recently, but essentially it's been relatively flat. But if I think about it, it's up quite a lot from the earlier part of the recovery, and it's still higher than it was in the past recovery. So overall, I'm looking at those sorts of numbers and saying, I expect growth to continue. I don't expect it to accelerate, but I expect sort of ongoing growth at rates similar to where we are. So that was a relatively positive side. So I'm going to go with the left-hand side as positive today. Now, on the right-hand side, we do have some data that's coming in that's, quite a lot weaker. So on the high-frequency side, we tend to look at these ISM indices, and they break down sort of, are the manufacturing community, are they seeing growth or reductions? So if you're seeing reductions in activity, the ISM indice will be less than 50. So right away, you can see in the near term, we're seeing an ISM indice that's below 50. Manufacturers are reporting that they are seeing decreasing levels of activity. And the non-manufacturers, while they're still positive, are also seeing their activity rates declining as well. They're getting less positive about how they are. Now, again, it's useful to provide perspective. And if I go back to earlier in the recovery, you can see there were a couple times that we saw really weak manufacturing numbers. And both of those times were times where the Federal Reserve, among other entities, was focusing on trying to keep the economy growing. So it's not unusual that we're in today's situation and seeing things as quite negative, and the Federal Reserve is responding, as we'll see. Now, it's a whole lot better than during the recession. But if you go back to the prior recovery, you can see that it's pretty unusual for manufacturing to actually dip down to negative territory. And so, it's not a really good indicator that we're seeing that today. Where is that coming from? Well, I've got a different version of the IP, industrial production across the world, and the merchandise trade environment. And, on both of these measures, we're seeing really a very different trade environment. And this is how it kind of comes to us. So I want to point out again, one, the very near-term data, these are very low numbers. So international trade is not generally going to be a benefit to the U.S. economy. We're likely to see those net export numbers being low. Again, there's kind of two periods where trade and industrial production dip down to very close to zero. Those turn out to be the same time that our manufacturing indices dip down to zero. So when we see a weaker international environment, it has impacts on U.S. manufacturers. Those U.S. manufacturers have impacts on sort of how do we see our economy. The last thing I'd like to point out about this chart, and this is one of my new favorite charts, is that if you go back to the sort of 2000 to 2008 period, or 2007, you can see that, sort of throughout that entire period of time, merchandise trade was growing at 5 to 10% levels. And world industrial production was running about 5% growth as well. That was a very powerful expansion in the entire sort of international environment, and in particular in China. Post-recession and pre-actual, sort of trade difficulties, we never really see, once you get over that initial recovery phase, once you get past we've got a recession to get out of, once you get into sort of 2011, you don't really see that sort of return to that higher level of trade. So in my mind, when I think about where are we as a country, I don't see, trade coming back as a sort of positive factor in our U.S. economy very quickly, just because the overall international environment has just generally been slower and hampered by trade disputes. Okay, that was clearly weighing on that right-hand side. That is a down feature for the U.S. economy. So what else is still out there that's going to help us? Well, the labor market has been really very strong. I mean, I always think, okay, I'm looking at some possible upcoming seniors here. We want to point out the labor market is still good, and that is still the case. We are seeing 120-some thousand jobs per month. That's a really great rate, and despite the fact that we actually had a GM strike that was pulling down that employment number by about 46,000. So we are still seeing exceptionally strong employment. And there were two revisions to past data to sort of boost what we had seen in previous months. So I'm seeing no real downturn in employment growth. That's going to continue to put pressure on labor markets. The unemployment rate is running down to 3.6%. That is extraordinarily low. I have to go back to the 1960s to hit that level of unemployment rate. We would not be able to sustain the employment growth that we are seeing if we were not drawing more people into the labor force. And that labor force participation rate has just started to trend up a little bit. Now you might say, hey, that's still really low. But that number, in sort of the normal economy would be declining. And it would be declining primarily just due to demographic change. We have more baby boomers entering retirement years, and therefore we should expect to see our labor force participation rate decline because more of them will be choosing to retire. And the incoming generation is not large enough to offset that. Okay, I gotta be quicker with this slide. So on the concerning side, though, is we have seen some evidence recently that businesses have been cutting back on their openings. So this is an interesting thing to look at. I thought, well, then, maybe that's a sign that businesses are a little more concerned about their environment. Looking a little more carefully, though, I see that hires have actually continued to be uninterrupted. So there's no similar downturn in hires. And so what that's meant is that businesses for whom in the U.S. hires generally have been exceeding openings for, more than a decade, have, responded to the tighter labor market by actually cutting back some on openings. And that's something that we've heard from businesses that we talk to. Last year I had a big focus on compensation. It's still ticking up slightly. It is still moving a little higher, but at compensation growth at about 3% per year. We would still describe that as very moderate. And again, this is one of those cases where you can see that it has gradually moved up from where it was at the end of the recession, but we're still not seeing the sort of compensation growth that we saw in the earlier cycle. So that's going to be a factor on why inflation is relatively moderate. Inflation is at the FOMC's objective is for 2% on the PCE inflation rate. You can see that both the blue and the yellow line, the blue line being all goods and the yellow line getting rid of food and energy, Both of those two measures have tended to be below that 2% objective for most of the expansion. That's an environment in which Federal Reserve policy is likely to be more accommodative. Now, in the past, I've shown you more about the outlooks, and this time I decided just to show the actual projections. So this is the interest rate that the Federal Reserve uses to adjust, to sort of set the conditions for the economy. And this is going to the September FOMC meeting. That's the last time that the committee rendered their opinions on sort of what is appropriate policy. So I want to point out that, there were 5 dots where they expected the end of 2019 that the appropriate policy would be above 2%. There were another, 5 dots to say that it should be between 1 and 3/4 and 2%. And then finally there was, somewhat more dots at the 1.5%. Now, looking out to the future, there are expectations that rates still need to rise over the next coming years if growth is to be maintained. But what's happened recently? So in the last FOMC statement, and this is the one from November, these statements have a form. And actually, the Wall Street Journal has a tool that you can actually use to say, okay, what specific words changed this time? And so this is actually the statement of conditions. And what you can see is that the only thing that changed was exports have been weakened, got replaced by exports remain weak. So that was the key change in the outlook, but that was not it was still the case that the FOMC chose to lower interest rates and lowered them to 1.5 to 1 3/4%. So going back to that earlier figure, that was the most commonly held view in September, but it was actually a minority view that, rates should be, in that range. The other thing that changed in this FOMC policy statement, though, is the last sentence. And that becomes one in which, in Fed speak, is essentially saying, look, rates are appropriate where they are today. We're not likely to lower them anymore. We will wait and see if there's some sort of incoming information that's significantly different. In speeches, the presidents and governors have said things like there's now a higher hurdle, or we're we're more satisfied with where we are today. And so that's a key change that, the Federal Reserve's policymakers have viewed today's situation as roughly balanced and roughly where they want to see things. So I'm ending with a comic relief, because I haven't had enough jokes in my talk. And so, of course, there is this attitude about, hey, the economy could recover or it could not recover. But I do believe that you all are real. And, on balance, we favor the idea that the economy is likely to continue to recover. But it's not one without pretty significant risks. And what we've seen is the FOMC's policy-making arm basically chose to, have a little lower rate and to be a little more comfortable with having balanced those risks. So with that, I'm going to turn it over to the local perspective.
Well, thank you, Goran. Thanks to the Waldemati Center for having us here again. I last spoke to you in, 3 years ago. And unfortunately, the news now is somewhat less cheerful than it was 3 years ago. Back then, the Columbus economy was riding high. Now, unfortunately, not so much. Now, when I talk about Columbus or the region, what I'm referring to, with one brief little exception later on, is what is known as the Columbus Metropolitan Statistical Area, or MSA, 10 counties. MSAs are defined by the federal government based on worker commuting patterns, so in a very real sense, an MSA is an economic unit. So it's a very convenient unit to analyze and talk about. So here is total employment growth for the Columbus MSA, Ohio, and the U.S. Beginning in January 2010, running through March 2019. I begin it in January 2010 just because that's when employment started growing after the recession. The blue line is Columbus MSA employment, which is up 19.5%. The black line's U.S. employment, which is up 16%. And the purple line is Ohio employment, which is up 11%. This is the kind of chart that I have trotted out again and again and again. And you look at it and you think, oh, that doesn't look so bad at all. What's to worry? And I should stop and mention that these numbers on which this chart is based are not estimates. They are a census, the quarterly census of employment and wages. So these are the real deal. But let me show you a different view of the same information. This is annual percentage changes in Columbus MSA and U.S. employment between 2011 and 2019. The percentage changes through 2018 are calculated from the quarterly census. Year-to-date changes for 2019 are from a different source, the current employment statistics, which at this point run through September. The current employment statistics are an estimate. The total employment estimates, that is for all employment, are reasonably reliable, but the estimates for individual industry sectors can and sometimes are fairly significantly off. So we need to recognize that the 2019 year-to-date growth rates are provisional and take them with a grain of salt. But this is the best information that we have now. And this chart shows why I am worried about our economy. The blue bars to the left are Columbus MSA, the black bars to the right are the US. We were growing north of 2% per year in employment through 2016. We fell to 1.9% in 2017, still respectable and still greater than the national average. But then in 2018, our growth fell to 1.4%, and for the first time in a decade, our growth rate was below the national average. So far in 2019, we're growing at 1.2%. Compared to the national average of 1.6%. I should mention that 1.2% was exactly my forecast for the Central Ohio economy in 2019, but this is one time that I kind of wish I were wrong. We obviously can't keep growing faster than average forever, but that certainly doesn't absolve us from the need to try to figure out what's causing our region's slowing growth. And there are two primary industry sectors that are behind much of the problem. The first of these is retail trade. Employment in retail is just under 100,000 in the Columbus MSA, close to 10% of our total employment. Over the past 2 years, retail has lost more than 11,000 jobs, with ongoing consolidations and bankruptcies affecting a number of local retailers and a totally inadequate rate of small retail formation. But that's a topic for another day. So you may be wondering about that odd little growth spike in 2017. That's 5.3% growth in Columbus MSA retail, around 5,500 net new jobs. Now, I can't be totally certain, but I very strongly suspect that those were the new Amazon warehouses. Those jobs in those warehouses, even though they're warehouse jobs, might very well be classified in a retail industry called non-store retailers. So they hired up, they got the people they needed, we had a nice bump in retail employment, and then the bottom fell out. Our second problem child is professional and business services. That accounts for more than 170,000 jobs in the region. And its last good year, as you can see from this chart, was 5 years ago. This is a very broad sector. It includes 3 main subsectors. The first of those is professional and technical services, including most non-medical professional offices, R&D, marketing, and public relations. The second subsector is corporate headquarters and regional offices. And the third is administrative support and waste services. That includes business support services, services to buildings such as landscaping, pest control, janitorial services, and waste collection and remediation. It also, very significantly, includes all temporary employment, regardless of the industry in which the temporary employee works. So the problem in this broader sector is with those last 2 subsectors, corporate headquarters and administrative support. Corporate headquarters employment has been absolutely flat since 2015. That's really, really concerning, because this is supposedly one of Central Ohio's key economic drivers, and it pays the highest wages on average of any industry sector. Administrative support has been very weak in recent years also, losing about 1,000 jobs over the last 2 years. Here it's pretty clear that the culprit is temp employment. And this makes me wonder whether a big part of the problem isn't workforce, because temp employment is a first job for many people. One fact that I pointed to time and time again in arguing that workforce is a problem is the high employment growth we saw early in the expansion. Between 2011 and 2017, our employment growth averaged 2.1% per year. Meanwhile, the growth of the prime working age population was 1% per year. You cannot grow employment by 2% per year and grow the relevant population by 1% per year and not expect to run into trouble eventually. You do not need a PhD in economics to know that. So I've now fulfilled the economist's principle. If you can't say something nasty, don't say anything at all. So with that box checked, let me quickly move to a couple sectors that are doing just fine. The first of these is private education and healthcare. That's more than 90% healthcare, because the education piece is only private education, like the people who teach here. That has added nearly 45,000 net new jobs since 2010, growth of 35%. Government is also doing a whole lot better than average. The driver here is state government. The share of all Ohio government jobs in the Columbus MSA has been increasing more or less steadily since about 1991. Finally, construction has been going gangbusters. A net gain of nearly 12,000 jobs, 43% since 2010. Now, one sign that the reduction in total employment growth is probably not being driven by the underlying economy is the pace of job postings. What I have here is help wanted ads in the Central Ohio Economic Development Region. That's slightly different from and somewhat larger than the MSA, and this chart begins in 2014. The blue line is the raw monthly total. The black line is a 12-month moving average. The pace of job postings lately, as you can see, is steady to somewhat higher. However, there is a much longer-term problem, a major problem, that we're going to have to contend with, and that is a point that, that Mark made. The demographic changes that are going to really, really put a squeeze on workforce. What I have here is past and projected growth in 4 major age groups in the Columbus MSA between 2000 and 2050. The projections out to 2050 are from the Ohio Development Services Agency. The 24 and younger group is the blue line, second from the bottom. 25 to 44 is the purple line there on the bottom. 45 to 64 is dark blue, second from the top. And 65 and older is the black line that's just surging upward. That dashed gray line is total population growth. The senior population is projected to be 142,000 more in 2040 than it was in 2017, an increase of 53%. This population was 10% of the total in 2000. It's going to be 17% of the total by the time we get to 2040. Meanwhile, the primary working age population is going to be increasing at a much slower rate. The projections imply that the 25 to 44 group, as you can see, is barely going to grow at all, meaning that there are going to be about as many people aging into that age cohort as will be aging out. But the younger end of this group is very heavily impacted by movers because people tend to move when they're younger. They tend to move much less often when they're older. And so that projection, the 24 and younger and the 25 to 44 projection, is probably the sketchiest of all of them. In any event, the slower increase in the working age population is a national phenomenon. It's not just happening here. So we can expect more and more jobs to be replaced by technology. Although there's an interesting argument that technology as a whole is going to result in a net increase of jobs. That too is a topic for another night. Clearly, though, we need to keep more of you students here in the region. You don't want to go to Chicago or New York or someplace. You want to stay here. You want to go to Cleveland. Build our economy here in Ohio. We also need to emphasize education and training to wring all the efficiency that we can possibly wring out of the labor force we have and we're going to have. And let me conclude with a shameless plug. I'm going to be releasing my 21st annual Regional Economic Forecast at the Columbus Metropolitan Club at high noon on January 8th, and you all are invited. Thank you very much.
Thank you for these insightful analyses, and I would like to ask you whether you have any questions of each other before we open the floor for the audience.
I have an odd little question, and I don't know if this is quite answerable, but that is, how do you think the next recession is going to begin? What's going to kick it off?
Trade. No, you never really know what sort of imbalance or where the shortfall is going to be. There is kind of interesting work that one of my colleagues is doing that, if you look at past episodes of recessions, we tend to look at them as very abrupt happenings. But most of the time, there's places where you're already seeing the antecedents to the problem already happening. And it certainly turns out that was the case in the Great Recession as well. That, we actually saw a lot of housing problems in Cleveland, but also other parts of Ohio, Denver, before we actually got to, officially being in recession. And so, people on the ground were concerned about those things. They saw them, but they didn't, think they were quite large enough to actually be the cause of a recession. But I would tend to look around for where do you see trouble and where do you see difficulties, and that's why I somewhat flippantly said trade.
Yeah.
But if I'm looking at what's the weakest part of our current economy, our current outlook, it is the sort of international conditions, it is the sort of overall trade picture.
Yeah, I would back that up. I think that it's not so much trade in and of itself. It's the virtuous circle that you get between trade, the impact on competition, innovation, and productivity growth. And I think, if you look at the impact of Brexit, I don't really want to talk about Brexit because it's so painful, but as an economic issue, but we've seen this huge uncertainty about now going on for 3 years about will we or won't we leave the European Union, and under what conditions will we leave, and what might our future trading arrangements look like. Basically investment has just stopped in the British economy because of the huge amount of uncertainty, and that's going to have this knock-on effect, I think, on economic growth. And in fact, today's numbers I saw, it looks like the UK economy is sort of putzing along at about 1.2, 1.3%. And I think that's partially driven by what's going on in the euro area generally, but because the euro area is kind of weak. But I think it's this dynamic connection between trade, competition, innovation, and productivity that matters. And it's sort of the longer run effects. And in fact, we know from pretty recent economic analysis that if you just look at static models of international trade, the gains from trade can vary anywhere from, if you had big increases in trade liberalization through free trade agreements, that you can get fairly modest increases in economic growth. But when you add in the dynamic effects, you get quite big jumps. And so I think it's the dynamics of the connection between trade and the economy that matter most. Maybe not so much for the US economy, but certainly for, especially economies in Southeast Asia. I think they're affected by the messing up of the value chains at the moment.
So I'm kind of curious, in some sense, the Columbus economy has been a fair share of overall Ohio growth. Mm-hmm. And, in part what I heard you saying is, look, we've kind of, we might be running into limits. So one of the things I'd say is, one of the reasons you can have a shortage in temporary workers is there aren't any workers left.
Right.
Is that your primary view of sort of what's kind of slowing Columbus down? And, if so, does that just move to other parts of Ohio, or is that, impinging on our sort of overall state prosperity?
It is. It definitely is. And I would agree. Well, you can't know for sure, but I very strongly suspect that it's the labor force and its growth limit that's starting to hurt us. And one experiment that I've been running for the entire expansion is to pull the Columbus MSA out of Ohio and look at net Ohio. And that drops that drops Ohio growth by a couple, 3/10 of a percentage point. And we don't have that anymore happening. And so the Ohio economy, I think now is growing at about 0.5, 0.6 in employment. And I put the blame squarely on the Columbus MSA for that. And yes, it's going to hurt the rest of the state, no doubt.
I have a sort of nerdy macroeconomic question for Mark. You know, I've been reading recently about this, you know, this idea that central banks, including the Federal Reserve, are maybe having problems meeting their inflation targets. And there's, you know, I was talking to Bob Gitter over dinner, and, you know, he said he was a professor before this paper was written, but I think I was just a young student when this was written, the paper by Kidlin and Prescott that told us that, you know, monetary authorities had to think about the way people and agents in the economy form their inflation expectations, and this was very important in thinking about monetary policy. So Mark, do you buy into this argument that this generation out here sitting down the front of the room, they've never really experienced inflation? In other words, they don't even have expectations about inflation anymore compared to, say, Bob or me, or, you know, I got gray hair on my head too. I was just listening to the Beatles when I'm Sgt. Pepper coming up, and I heard When I'm 64, and I thought, only one more year, and that song is actually true. And I was a teenager when that was released. So Mark, I mean, why can't we meet inflation targets? And does it have something to do with the way inflation expectations either aren't being formed or I'm not quite sure, you know, the way central banks are thinking about this issue?
Yeah, well, let's just first say that, you know, it's a sort of broad international issue. So I pointed out the Federal Reserve's been below our inflation objective. So too has the ECB, the Bank of Japan. It's a broad-based issue. So we are all looking at how do we think about those inflation expectations. Now, you know, when I went to school, I did go to Chicago, and, you know, we were always taught that inflation is always inexorably linked to money. And monetary policy should be able to determine what the inflation rate is. But, you know, it's definitely a more complicated environment, and we are reacting to the fact that, you know, people do have kind of strong expectations that we will not have a big 1970s inflation anymore. And we watch expectations really carefully, and they have gradually come down. So I do expect inflation to be lower. I think it is still important for the Federal Reserve to focus on a 2% objective and to not say, oh, well, you know, if we can't achieve 2%, well, let's go with 1. We've been able to do that. I think it is important that we try to set that objective, and, you know, policy is just got recalibrated because, in part, we were not hitting our inflation objective. So that is an environment where we are trying to prolong and expand growth.
And I'm kind of wondering if demographics might play a role too. I did a study a few years ago with the Center for Community Solutions in Cleveland, looking at the spending of older Ohioans in the context of sales tax. And it turns out that older people spend less than younger people. And so I'm just wondering, as the share of the older population increases, if maybe that's just going to kind of put a limit on consumption growth in the longer run.
So consumption growth is one thing, but I mean, our inflation rate should still be kind of independent of that.
Well,
so, you know, we should be able to, you know, sort of monetary policy should be able to sort of over the longer haul hit the 2% objective.
yeah.
But I do agree, you know, look, we are puzzled on exactly why it is lower. You know, yeah, demographics are one thing, but the demographics also cut the other way. So one of the things that we all said is that, or the two of us said was, look, there are fewer young people There are more older people. Those older people are working less. Therefore, there's overall less supply in our economy. And that reduced supply should make a lot of things, more, it should pull back on supply, causing prices to be higher.
But on the other hand, you have technology and productivity and artificial intelligence. And I guess it's an open question, which of those two is going to win the day?
Yeah, I mean, and one of the things, but, in some sense, we've been watching productivity growth in the U.S. reportedly slow. So we are not seeing a productivity boom in today's economy either. So I absolutely, it's a fair question. It is one that, the Federal Reserve has been sort of examining as part of examining how do we think about our policy framework. That's one of the topics that people were talking about, is if you can't hit your inflation objective, do you need to modify it? The FOMC has largely stated already that they're not going to change the objective, and that we should still feel obligated to work at that objective. But yeah, it's we could join the English. The English have managed to hit theirs at times, but the rest of us central banks have struggled. But, I think one of the things that we've learned out of that is it's very important to have a very strong commitment that you are aiming at that objective, and that objective is symmetric.
Oh, yeah.
Any other questions of each other? How about we open to the floor? Any questions from the audience? If you have a question, please raise your arm. We have a microphone for you because we are videotaping this, and if you don't speak in the microphone, audience cannot hear you. Over here. Hold on.
How do you think so Tesla's rolling out their Gigafactory 3 in China sometime this month or next month? How do you think that will impact the trade war? I don't think it'll be like a zero-sum game, but it could be beneficial to both counterparties because they're buying U.S. manufactured cars, but in China. Do you think it could be a beneficial boost factor for the trade war?
So your question is about investment by Tesla?
Yeah, impacting the trade war.
And that investment is in China?
Correct. Yes.
That's a tough question. I think we've observed, as I said in my talk, there's been a pretty significant slowdown in both car production and sales in China. Remember, average Chinese incomes, I think they're about $12,000, $13,000 at purchasing power parity still. So we're still talking about an economy by any judgment is still an emerging economy. And I think, maybe there'll be a few people in the 90th percentile of the Chinese income distribution living in Beijing or Shanghai are going to purchase Tesla automobiles, and that'll lead to some imports into China. But remember, China picked 3 key sectors when it retaliated against the first round of tariffs by the US. It picked aerospace, which is our #1 export to China. It picked soybeans, which is our #2 export to China, and automobile parts, which is our #3 export to China. So I think, it's probably a bit of a wash. I don't think a specialty automobile being built in China is going to really change the dynamics when we're talking about we almost have tariffs on 500 billion of their imports, and we're talking about, significant tariffs on a significant range of our imports. So I don't think that's particularly going to change anything, except for maybe the shareholders in Tesla maybe will do well out of it.
Thank you.
Have any industries or groups, Chinese or American, actually benefited economically from the trade war?
Initially, I'd say there was no question that you saw improvements in steel making. So the steel manufacturers, responded really quite quickly and aggressively with price increases. So domestic steel producers, were suddenly, more profitable. Now, one of the things that you learn is that, over time, that'll end up tending to be diminished. And what we've seen is that, ultimately, even in the area where they had the most attention and the most focus of tariffs and a clear benefit at the start, those benefits have diminished, and now we're seeing, an environment that is becoming more equivalent. As Ian pointed out, I mean, one of the first things you see when you see tariffs is you see a depreciation in the foreign currency. So you institute a tariff, but then you make it cheaper for them to sell whatever they were going to sell abroad because they've now depreciated their currency. And this happened both with Mexican pesos and also renminbi.
Right. Yeah, I mean, it's still a little early to say what the job number effects have been here in the US. I think we've seen pretty modest increases in employment, particularly in the steel and aluminum sectors. I think one thing you have to pay attention to is that we've seen a lot of what economists call trade diversion, and that is imports that were coming out of China are now being diverted through the value chain to other countries. So the Chinese exporters are chasing value chain routes into the US economy that avoid the tariffs, and that's one of the reasons why the trade war hasn't really had any significant impact on the bilateral trade deficit that we're running with China. I mean, the most reputable study that I've seen of at least the short-run effects of the trade war on the US economy is that it's still an NBER, National Bureau of Economic Research working paper. They calculated that the net impact on the US economy last year was about $6.5 billion, which is a relatively modest decline in US GDP. But that was largely driven by the fact that firms were mostly affected by the initial tariffs, and a lot of firms were actually absorbing the costs of those tariffs. These are firms importing intermediate goods to use in manufacturing in the US. And it generated about, I don't know, $40 billion worth of tariff revenue, which is actually a drop in the ocean. It's less than 1% of the revenue take. It's a complete myth that tariffs are a major form of revenue for the US government. On the export side, I work in the ag sector, and China is the largest importer of soybeans in the world. We're talking about nearly $40 billion worth a year before the trade war began. And the US was basically competing mostly with Brazil for market share, and we were exporting from the US about $14 billion worth of soybeans. Ohio, as a state, exports $3 billion worth of soybeans, of which about 1 in 3 rows of soybeans were going to China from the state of Ohio. Right now, just to give you an example of the cost to US farmers, only about 1 in 10 rows of soybeans are going from Ohio to China. There's been a huge reduction in the amount of those imports. Now, you need to factor in the fact that if you don't follow these things, but the Chinese have had a phenomenal increase in meat consumption since they opened up their economy in the 1980s and their economic growth took off. So we've seen a very high correlation between income growth and demand for protein. And the Chinese, even though the soybean is indigenous to China, they're simply unable to grow enough soybeans to meet the demand for animal feed. And one thing that has led to further softening of soybean prices for US exporters is there's been this huge outbreak of African swine fever, which I've read has wiped out 40% of the Chinese hog production stock, and that's leading to additional downward pressure on soybean prices, and it's hurting soybean farmers, but of course it's potentially helping US pork processors who are exporting. So we're exporting animals that embody soybeans, but the Chinese still have a 73% tariff on imports of processed pork, which is a bit of a puzzle to me because there's been a 100% increase in the price of pork in China, which is an important product in their diet. So job-wise, I don't think the trade war has really benefited the US in any meaningful way. It's certainly hurting the value chains, particularly as they relate to Chinese product assembly. I think, though, China is probably looking to start offshoring assembly itself anyways as it moves up the value chain. I mean, if you think about Lenovo computers, why would China continue to assemble those computers in China if they can offshore assembly to a country like Vietnam? So I think, you know, we're seeing some dynamic effects. And I think it's important to remember that China on the food import side is trying to diversify where it gets its imports from. So even before the trade war, it was already shifting imports to countries like Brazil, to some extent to Argentina. China's investing huge amounts in pork production for support facilities in Brazil. It's investing in soya processing facilities in the Ukraine and the former other parts of the former Soviet Union, which, if they ever get their act together on commodity production, could you know, subject the U.S. ag sector to significant competition. You know, that's a long answer to a short question, but I don't think, as Mark said, we've seen any significant job. I mean, the problem with the steel industry is it's not blue collar anymore. It's highly automated, right? So if you're reinvesting in steel mills in this country, it's not the old, you know, Pittsburgh Steel, Bethlehem, Pennsylvania, whatever. It's highly automated, capital intensive, a lot more less labor intensive than it used to be.
Yeah, I mean, there's been relatively little change in steel production in the U.S. There's primarily a change in the sort of value of steel producers because they got a higher price, but our steel production was not really running that much below capacity. It went up to capacity, and now it's kind of dipping back down again. So even, you know, that's probably the place where you should look for gains, but, you know, it's a lot easier to potentially, I mean, there are challenges to shifting where you produce something anyway, but it's very difficult to sort of, you know, sort of speedily say, okay, I'm going to double steel production. That just can't happen.
Right. And even though that, you know, we implemented significant tariffs against imports of steel, not just from China, purportedly for national security reasons, the US has been implementing both anti-dumping duties and countervailing duties against Chinese steel imports for some time, going back to the Bush Jr.'s, G.W. Bush's administration. And you may be surprised, just throw out, you know, I can't help being a professor here, anybody in the room know what share of US imports of steel were coming from China before the start of the trade war? Anybody want to hazard a guess? 6%. Our major supplier of steel and aluminum were actually our friends to the north in Canada. And so, you know, it's not true that we had not tried to protect the US steel sector. And the problem with the steel tariffs is they simply shifted so there's global overcapacity in steel. We've simply shifted the problem from the US out into the world market, driven prices down elsewhere. And so this is just kind of a, you know, it's a problem that we've just shoved off onto somebody else, I think. There's a gentleman over here, a gentleman here.
How does 1 year from now, we'll have the election behind us, any observations on how that could impact the economy in terms of what we currently are seeing? I mean, it's kind of a wild card, and I'd just be curious on your observations. It's kind of the elephant in the room.
Well, I normally try to avoid election questions, but I'll try to handle this in a very sort of unbiased, scientific way. So there's a measure out there, an uncertainty index, that does a good job of talking about political uncertainty, and you know that thing has been shown to influence the likelihood of businesses investing and expanding their operations. So this environment where you have a lot of uncertainty, where uncertainty is rising, is counterproductive to growth. If you achieved an election outcome that, you know, improved the certainty environment, that would be beneficial to growth. There's still relatively small differences. I was really tempted, then I decided it would be unfair to put Ian under this pressure, but you know, we've seen the stock market react relatively quickly to any sort of change in the tariff news. But, when I look at it, I would question, how soon anything could change that would actually be affecting companies' profits that much in a process that's actually been ongoing. So I think, I don't want to overstate, any election effects. And, I think scientifically people find that they're there in the form of uncertainty. We would prefer an economy where there was a little less economic uncertainty.
Bill?
Safe, huh?
Very safe.
I guess, we know the effects of the corporate tax cut of kind of washing out probably over the next 6 months. And I'm not sure with the budget deficit that we're running right now that whichever administration is elected is going to have much wiggle room in terms of affecting the economy through government spending. In fact, I think the big debate has to, we're running at, what's the number? What are we running on the budget deficit right now?
We're approaching that 1 trillion mark.
We're approaching the 1 trillion. We've got to start grappling as a society with how we probably try to bring down that budget deficit. And there's a lot of concern about the fact that, and I talked about this last year, that as we continue to run a trade deficit, we're continuing to run up obligations that we have to foreign investors in the U.S. economy. And I mean, all the time foreigners are willing to buy U.S. treasuries or whatever other assets we have. We can continue to run a current account deficit, but you never know. That there might be some turn against that. But I don't know whether Mark would agree with me, but I think presidents have very little influence over the economy in a general. They don't have many instruments at their disposal. And I think, other than pushing through tax bills, and I don't see any big changes to fiscal policy being pushed through Congress right now. I mean, that's my gut feeling by either administration.
I guess I would point to sort of other economic reforms. So, I mean, OECD would sort of always emphasize that there are other reforms that you can pursue in your economy, and those have large enough effects potentially to sort of shift growth. But
you mean regulatory changes?
Regulatory changes, or you think your labor market is, could use just sort of to take it off of the regulatory side. Do you think you can improve matching in your labor market? So active labor market policies are something the OECD generally supports and says are effective in other countries. Active labor market policies are not something we've done an extremely good job of in this country.
Right. I think there was a gentleman over here had a question.
I'm perplexed by wage growth. It seems like everyone's always complaining about how wages have lagged. And Mark, your chart up there had 3% wage growth, which to me, for most people, would sound pretty good, I would think. And then I thought, well, maybe it's because of benefits, or maybe that total compensation's increased by above average increase in benefits. But it looked like the wage salary line was right on top of the total compensation line. Could you explain that and why 3% isn't a bad number? I mean,
so 3% is not a bad number, but that's a nominal figure. So if we're hitting a 2% inflation objective, then you want to see your workers getting something that looks like productivity growth in the economy. So when I try to think about what's a solid rate of compensation growth, I'm expecting a combination of inflation plus productivity growth, and that's how we improve our living standards over time. So I generally want to see a stronger number there. The other thing I would say is that, if you're looking at an inflation environment where you're perennially running too low of an inflation rate, many of those inflation rates are actually services. So when we think about what we consume, we're thinking about goods and water bottle prices or gasoline prices. But the services that you're getting from your insurance company or the services you're getting from restaurants also count. And, kind of across the whole picture, we're not seeing an inflation rate that's kind of lining up with that 2% objective. So, as wanting to see that 2% objective, seeing a little more compensation growth would be helpful for that. And at some point, The other thing that I didn't highlight in that picture, but is worth remembering, is when you hit a recession, compensation growth pulls back a lot. And then it's a very slow process to get back up there. So we saw a large pullback in the recession in compensation growth. In some industries, it got down close to zero. And that recovery, is still not enough to sort of keep the sort of labor share of income constant. So I'd like to, that's kind of another metric about sort of how do the workforce of the economy fare versus the owners of the capital. So I think, there's still room to grow. 3% is good. I would have liked to have seen 3% a couple years ago. But we are making progress there, and I am happy to see compensation gradually rising.
I'm just kind of worried for our generation's growth in the future. So with baby boomers retiring very soon and putting a big strain on the Medicare funds, I understand that they might be depleted by around 2030s-ish. And with the fear of an upcoming recession, decreasing confidence, and the trade war going on, do you think that this upcoming recession will be a fairly bad one? And if it is, do you think we would have any means to alleviate the effects of it?
Well, that's a good challenging question, good front row seat. I appreciate the challenging question. Now, so let me first say that when you try to predict whether a recession is going to be deep or not, or sort of how big is a recession going to be, there's really no method that economists have discovered to reliably predict that. So going into the Great Recession, we had no idea that this was going to be exceptionally large until things, until we entered kind of the financial crisis part of it, in which case we were concerned about just sort of how big or how deep or how troublesome could it be. But there was no way to predict that in advance. So I don't think anything about today's conditions point to an abnormal risk for a deep recession. Now, you raised a more of a long-run issue, and that's about sort of thinking about the Medicare and Social Security trust funds. And, one of the things that, I think it would benefit the U.S. a lot to be able to rein in our costs for medical expenses, because relative to every other country in the world, we have very expensive medicine, and we have very expensive medical costs. And those do have to, in many cases, be borne by taxpayers, because we do have a system in which older workers are covered by Medicare. So I do think that there is an issue there, but again, that in my mind comes down to sort of the country needs to state sort of where its priorities are and how much is being offered to that system. So it is solvable. Our economy is large enough that we can afford that, but you have to make choices along the way. And then I would say, from a generational perspective, I think there's a lot of worrying about, what does the retiring baby boom do to the entering class? And I would say the first and foremost thing is retiring baby boom means that you've got a tighter labor market. And that is an environment in which you would expect that this generation ought to see better wage growth, better job options, where, as an economy, we need this generation to be extra productive. So, in some sense, there's a countervailing argument to the pessimism of, we've got a lot of baby boomers we have to pay for. We also have an entering generation that is not small and, is going to, be in the situation where there are a lot of relatively ample openings and ample opportunities.
In the U.S.-China trade war, you sort of mentioned Japan, and my question is, for the U.S.-China sort of like trade war going on, how big of an impact does it have on the Japanese economy, and is it beneficial or harmful to them in their growth?
Well, that's a difficult question. I don't think we've been paying much attention to some of those side effects. I mean, I think Japan is, yeah, I mean, one thing it has been doing is focusing on trying to expand its trade relations with the EU, and it's signed a pretty significant free trade agreement with the European Union, and I think we're already seeing the effects of that. For example, many Japanese automobile companies were attracted to Britain originally in order to get access to the EU, and Honda already have announced they're going to shut down one plant, and Mitsubishi is going to halve its capacity in one of the largest automobile plants. So I think Japan is it's not just the US-China trade war. I think where Japan is probably being impacted by the trade war is the fact that we have these hugely integrated value chains, particularly in the automobile sector, and that it's probably impacting, cost of doing business for these major Japanese multinational automobile firms, and where they're thinking about locating globally or expanding production globally. And I know that many Japanese companies were very concerned about what the what the renegotiated NAFTA, which basically it's NAFTA 0.2. It's nothing much really changed. NUFTA, the Economist called it. Economist magazine, that is. Economists aren't that funny usually. So I think the Japanese automobile companies, they've invested significantly here in the US. If those value chains are interrupted either in North America or with respect to China, I think it would, their long-term strategy would be to think about, where I'm going to locate assembly, et cetera, et cetera. So that sort of, very quickly. We in the US, I think, threw away a huge opportunity by not joining the Trans-Pacific Partnership, which would have opened up Japan, certainly in the agricultural sector, because that sector's been highly protected, and the WTO has never managed to successfully break that open. And I think it's kind of interesting that we didn't join TPP, and now the administration's trying to negotiate a bilateral with Japan, and you sort of have to wonder about the cost, incur the opportunity cost of all that time we spent negotiating TPP. We decided to back away from it, and now we're going to get an inferior alternative, in my opinion, in a bilateral with Japan. So, yeah, I mean, Japan is a mature economy. Mark can probably say more about it, but it's been in the doldrums for, nearly 3 decades, and it's hard for me to see that it's that export machine that it used to be, in the 1980s. Mark, I don't know.
Yeah, I guess on Japan, I'd say one of the primary influences is like other sort of very highly developed countries, a lot of Japan's main exports to China have been machinery and things to build things. And sort of the overall slowing of trade has had, negative impacts on the sort of very large exporting countries. Most of the time Germany's cited, but I would think that Japan would in many ways resemble that if you're one of the big sort of major exporters of the world, that, this weaker overall trade environment is having negative impacts on them as well. Yeah.
All right, well, I did have one more question, but I'll leave it for next year. I know Bill's going to come back.
Yeah.
All right, so thank you all for these very insightful analyses. Students and, particularly students, hopefully you've come to hear words that you hear in classes, so they're not only academic terms that you hear. I know students in my class heard about the yield curve today, about tariffs causing exchange rate appreciation. We learned that in class. It seems to be true. It's not just me blabbing stuff in front of the board. That to solve a trade deficit, we need to worry about our fiscal deficits. We heard that. We heard moving averages, right? We covered those in classes. I'm glad to hear that the job market is still good, especially for graduates. For those of you that are not that far along, hurry up. Before the job market tanks. I've been telling my students that a lot of them are going to be working in medical field somehow, not necessarily providing medical services as doctors and nurses, but support as insurance, as building retirement homes, and that seems to be the case. Today was confirmed that that is the biggest growth, especially in the area. So that's good. And one note to self, go buy a new iPhone.
Yeah.
All right. Thank you all very much for coming, and thanks to our presenters.
Thank you, Goran.
Thanks, as always.
So